Hey everyone, today we'll break down the latest financial news to help you understand the bigger picture. Today, we're going to talk about a crucial event that could reshape the global economy, the US Federal Reserve's recent rate cut. The Federal Reserve has recalibrated monetary policy, reducing the federal funds rate by 0.5 percentage points to a range of 4.75 to 5%. Now that we know this, what exactly does this mean for the US, India, and the rest of the world? Grab a cup of coffee because this is going to be a deep dive into how the Fed's decision could help send shockwaves across the economies, industries, and your investments. Alright, let's start with the basics. What is the Federal Reserve rate cut? The Federal Reserve, or simply the Fed, is the central bank of the United States. It controls the federal funds rate, which is essentially the interest rate at which banks in the US lend money to each other overnight. So why does this matter? The Fed uses this rate to influence broader economic conditions like inflation, growth, and unemployment. A higher rate makes borrowing more expensive, cooling down an overheated economy, but a lower rate, like the one we're seeing now, makes borrowing cheaper, which can spur growth. The Fed has just lowered the rate due to slowing economic growth, persistent inflation, and global uncertainties. So what does this mean for everyone? The new rate, which was previously set at a range of 5.25 to 5.50%, has been reduced. This marks a significant shift in monetary policy, particularly as the world watches the US approach in its next major election. According to Fed Chair Jerome Powell, this move is meant to balance the need of economic growth while keeping inflation in check. The Fed is also aware of the risk of prolonged economic sluggishness as inflation has remained stubbornly high. Now let's talk about the global implications and uncertainties. This rate cut doesn't just affect the US economy, it has global implications. We're talking about ripple effects across the markets in Europe, Asia, and especially emerging markets like India. Why? Because when the US cuts its interest rates, global investors start looking for better returns elsewhere. This shift could have profound effects on capital flows, currencies, and economic growth in other countries. For instance, a US rate cut makes American assets less attractive for foreign investors. These investors will likely divert their capital to emerging markets, including India, where the prospects for higher returns are greater. So, India could see a surge in foreign portfolio investment or FPI, which will have both short-term and long-term consequences. Now, let's assess the impact on India's economy from this rate cut. Let's zoom on India now. What does the US rate cut mean for the Indian economy? One of the first things we could see is appreciation of the Indian rupee. When more foreign capital flows into India, it pushes up the value of the rupee against the dollar. While this makes imports cheaper, especially for oil, it could also hurt India's export competitiveness. For sectors like IT, pharmaceuticals, and automobiles, this can be a double-edged sword. A stronger rupee could hurt export margins for IT firms, which earn a large chunk of their revenue from the US. However, increased demand and recovering US economy could actually offset these margin losses. On the flip side, sectors like automobiles and pharmaceuticals could benefit from the increase in demand as the global economy strengthens. So, while the rupee might appreciate, boosting imports, the overall economic impact will depend on how Indian companies adapt to the changing global landscape. Let's assess the impact on India's banking and financial markets. Let's talk banking. Indian banking sector stands to benefit significantly from this rate cut. Here's why. When foreign investors pour money into the Indian markets, it improves liquidity in the banking system. This means India's banks would see lower borrowing costs, which would make credit cheaper for businesses and consumers alike. That's a win-win situation for both the banks and the economy. But it's important to remember a strong rupee could hurt foreign earnings for large multinational companies based in India, particularly with significant operations abroad. So while some sectors thrive, others may face challenges. Now, what will be the inflationary risks? There's a potential downside we need to keep an eye on, and that is inflation. A rate cut in the US usually weakens the dollar, and when the dollar weakens, the price of commodities like oils tend to rise. For India, which is a major importer of oil, rising crude prices could trigger inflationary pressures at home. This would affect everything from transportation costs to consumer good prices. So while a stronger rupee might make imports cheaper, an increase in global oil prices could eat into those savings and push inflation higher. This is where Reserve Bank of India comes into play. If the inflation starts creeping up, the RBI might be forced to raise interest rates domestically to control it, even as the US Fed lowers its own rates. This delicate balancing act will be crucial for India's policymakers in the coming months. Zooming out for a second, this rate cut is happening in a very complex global environment. From geopolitical tensions like ongoing Ukraine conflict, the post-pandemic recovery and rapid rise of artificial intelligence, central banks are navigating a maze of challenges. The US is at the forefront of AI innovations with companies like Microsoft, Amazon, and Nvidia leading the charge. But these industries are not immune to macroeconomic shocks, especially when it comes to issues like regulatory policies and global supply chain disruptions. So, what's the final takeaway? The US Fed rate cut offers both opportunities and challenges for India and the global economy. While increased capital inflows can boost liquidity and stimulate economic growth, inflationary pressures and export competitiveness are key concerns. The opportunities that we have are stronger capital inflows, liquidity improvement in banking, and bullish stock markets in sectors like IT and pharma. While the challenges we face are potential inflation from rising oil prices, stronger rupee hurting exports, and RBI's potential response with rate hikes. What do you think? Will the US Fed rate cut be more of a blessing or a curse for India in the long run? Let me know your thoughts in the comments below. And don't forget to like this video, share it with your friends, and subscribe to Mastertrust to stay updated on global finance and its impact on your life. Thank you.